Okay, so let's start the class, guys. I hope that I'm audible. If not, please let me know through through your comments in the chat. So we will be studying a commerce and accounts portion in today's class. A very important topic that we have taken for today's class, which a lot of students might skip, and a lot of students are worried upon, is funds flow statement. So today we will be analyzing that how a funds flow statement is different from cash flow statement, how is it prepared, and so on. So basically fund flow statement is a statement prepared to determine the sources of uses of working capital between two balance sheet dates. If you know that, when we talk about cash flow statement, it talks about that how the cash inflows and how the cash outflows are occurring. So it gives it significance on the flows of cash. But when we talk about funds flow statement, it talks about flows which relates to changes in the working capital, right? How my working capital is changing between the two balance sheet date. What is the opening working capital versus what is the closing working capital, and why the change is there. Because of which components that there is a change in the working capital. We all know that working capital is nothing but the capital which is invested by the organization for its day-to-day business operations. And the formula that is used to calculate working capital is nothing but the current assets minus current liabilities. Why are we deducting current liabilities? Because these are the funds which are not invested by the organization on its own. Rather, these are the funds which are invested by its suppliers or short-term finance providers, right? So there can be certain inventory in the current assets which is given on credit by my supplier. So those credit that I'm getting from external parties should be subtracted from my current assets in order to know that what is my blockage of funds in day-to-day operations. And that is why working capital is having this formula, right? Next is the concept of working capital is used prominently to determine the liquidity position of the firm. So yes, we are interested in how the liquidity of the position of the firm would be in the near future. Are we having any expansion requirements, or are we required to pay off our debt or meet any obligations of our in our near future? So if things like that are there in the near future, and I'm well aware of that, I should be well prepared of the needs of working capital as well, that how much working capital I'll be requiring to pay off my obligations, how much working capital I'll be requiring to meet the expansion needs, and so on, right? So that is why the analysis of working capital is very, very important for each and every organization for day-to-day working. Now let's talk about working capital flows. When we talk about flow means change, right? So working capital flow arises. The change in the working capital will arise when the net effect of the transaction will change the amount of working capital. We all know that working capital is nothing but current assets minus current liabilities. If there is a particular transaction which is changing the amount of net working capital, we say that there is a flow of working capital and the working capital is getting changed. Let's analyze this with the help of certain examples, right? So before taking the examples, we all know that in any business transaction, whether the change in working capital would happen and there would be no change in working capital. Let's take an example. If I talk about changes in working capital, let's assume you have purchased a machinery. If machinery is purchased, what happens is, on one hand, your non-current assets are going up in the form of machinery, and the other, current assets in the form of cash, is going down. Since out of these two transactions, the change in working capital will be affected only because of decrease in cash, this transaction will be having a net effect in which working capital is getting changed, right? On the other hand, let's assume I take an example in which I have given bonus issue. If I'm coming up with a bonus issue, what is happening is that one part of my reserves and one part of shareholders funds, which is reserves and surplus, goes down, another part of the of shareholders funds, which is share capital, will increase, because when we talk about bonus issue, it is nothing but capitalization of your profits, right? So here both the transactions, both the effects of these transactions are not affecting the composition of current assets or current liabilities. Since this transaction is neither affecting current assets nor affecting current liabilities, in a sense working capital will remain same. So a business transaction can be there where there's no change in the working capital, or it could also be there when there's a change in the working capital, right? How and what is the shortcut to see that whether the change in working capital will arise or not? Let's analyze further more examples on it. First is issue of ordinary shares of cash. Whenever you are coming up with the issue of ordinary shares, the two effects of it would be, on one hand share capital is going up, and on the other your cash is also going up because you are receiving cash from the subscribers, right? The net effect of it is working capital will increase. Second example is purchased machinery for cash. One effect of which is non-current assets will go up, another effective which is cash as a current asset would go down. Again, working capital would decrease. Third is receiving cash from your debtors. When you receive cash from your debtors, one part of the current assets, which is debtors, going down, another part of the current assets, which is cash, going up. If you see here, current liabilities are not changing, but you talk about current assets as a whole are not changing, because whatever is the increase in cash, the same is the decrease in debtors, unless and until you have got some discount, right? You have given certain discount to your debtors. So in such cases, guys, your current assets will not change, though the composition of the current assets will change, right? Since the total current assets and current liabilities are not changing, the net working capital will also not change and will remain constant. Fourth example is payment of cash to creditors. Whenever you are paying cash to your creditors, on one hand your current assets in the form of cash going down, on the other hand your liability in the form of creditors is also going down. In a sense, the same amount of current assets is decreasing and the same amount of current liability is decreasing. Since both are decreasing by the same amount, your working capital again will remain constant. Because the formula for working capital, as you all know, is what? Is current assets minus current liabilities. Right? So since working capital is current assets minus current liabilities and both are reducing by X amount, the net working capital will remain the same. Right? The composition of working capital will change, but the net working capital will remain the same. Next is land purchase by issuing shares. When you are purchasing land but not paying cash, rather you are giving your shares, in this case, guys, what is happening is, one is your non-current assets is going up and your share capital also goes up, right? Because you are giving your shares, which acts as your internal liability. Guys, both of the transactions, both of the effects of this particular transaction is not affecting any current assets or current liabilities, therefore working capital will remain constant. Now, if you have, analyzed these transactions, what we can now conclude is this. Let's see in detail. Guys, when we issued ordinary shares for cash, cash is a current asset. It's a current asset, whereas ordinary shares is a long-term thing, right? On the other hand, when we talk about machinery for cash, machinery is a long-term thing, non-current thing, whereas cash relates to current thing. Debtors relates to current and cash also relates to current assets, right? You know it. Cash and creditors both relates to current item. One is current asset and other is current liability. And when we talk about land purchased by issuing shares, land is also long-term, non-current asset, and shares are also long-term, which is long-term internal liability or long-term capital. Guys, now if you can see, if one is long-term, another is current, short-term or current, then working capital is getting changed. Similarly, if one is long-term, another is current, working capital is getting changed. Similarly, if there are both current, working capital remains constant. Both non-current, then also in the fifth example, both are non-current, then also working capital is remaining constant. In the fourth example, both are current, working capital is remaining constant. So guys, if both the transactions are hitting the current aspect, both are hitting the current aspect, or both are hitting the non-current aspect, then working capital will not change. But if one is hitting the non-current aspect and other is hitting the current aspect, then your working capital flow would happen. It will change. Now you have to see whether it is increasing or decreasing, that you have to see. But if one is non-current and other is current, your working capital will definitely change. If there are any doubts, please let me know, guys. Okay, another example is coming up in which you have converted debentures into equity. So debentures and equity both are non-current. The answer should be the working capital will not change, right? But if you analyze, debentures is the long-term liabilities and equity shareholders funds. Since both are non-current, your working capital, which is current assets and current liabilities, are not changing. Therefore, working capital is remaining constant, right? Similarly, when we talk about the flows relating to P&L account, whenever you are receiving revenue, whenever you are earning revenue, that is the time you record your revenues, right? Revenue earned can be because of the cash sales or it might be because of the credit sales. In both the cases, guys, your current assets will go up. Cash as a current asset would go up or debtors as a current asset would go up. So normally, whenever you are earning revenues, your working capital should go up because the formula of working capital is nothing but current assets minus current liabilities. Since in this case, cash is going up, your current assets are going up and therefore working capital will move up because of revenues. Similarly, because of expenses, what happens is either your cash goes down, or if there are any salaries which are outstanding, or if there are any electricity expenses which are outstanding, your cash would not go down. Rather, you will be booking an outstanding liability, which is nothing but a current liability. Current liability going up. Guys, in this case, either cash would go down or current liability would go up. Formula for working capital is current assets minus current liabilities. If cash goes down, working capital as a whole will go down. If current liabilities increases again alone in isolation, then also working capital will fall. So the conclusion is that generally because of revenues, your working capital will increase, and generally because of expenses, your working capital will go down. Right? But in case of depreciation and amortization, which is also an expense, the things are that one is your depreciation is charged as an expense, another is your non-current asset, the value of it decreases. Nowhere because of this transaction it is hitting any of the current assets or current liabilities. Therefore, there are certain expenses which do not lead to any changes in working capital. So guys, what we do is that whenever we talk about what is the change in the working capital, amount of change in working capital, what do? We know that because of revenues, my working capital will go down. Similarly, because of my expenses, my working capital will go, because of revenues, working capital would go up. Because of expenses, working capital would go down. So in a sense, what do? We take the net effect of this and say that because of funds from operations, which is nothing but a form of profit, adjusted profit, we say that because of funds from operation, working capital would go up on a net effect. I hope that this is understood through each and everyone. If not, you can please reply in the comment. I'll answer your doubts or queries if any. Guys, when we talk about funds from operations, it includes all the expenses. And we only understood right away that there are certain expenses which are not leading to any decrease in working capital. If depreciation and amortization were also there in expenses, because of which your funds from operations has gone down and working capital also is understated, that is the reason we need to adjust funds from operations. So whenever you say that what are the sources of working capital, the first one is funds from operations. As the name suggests, sources from where you are getting the working capital. Funds from operations, as I told you, is a form of profits from operations, which is revenues minus expenses. But since in expenses we have also reduced depreciation and amortization, and it is a non-cash expense not reflecting my working capital at all, I will be adding certain of those expenses which are not involving any cash outlay. Since there was no change in the cash outlay, or since there was no change in the working capital, your current liabilities also not did not went up, did not go up, right? So in this cases, you have to increase or you have to add back amortization or depreciation because because your funds from operations is understated because of charging amortization and depreciation. Therefore, you add it back. Similarly, guys, when we talk about funds from operations, it also includes the gain or loss on sale of non-current asset. If your funds from operations is involving gain, you have to deduct that gain on sale of non-current assets. Similarly, if there's any loss, you have to add it back from the funds from operations. Why are you doing this adjustment, guys? Is because there is a separate item which is sale of non-current assets, which is taken as a source of working capital. So whatever is the net book value, we are not looking at that. We are not increasing that. What are we increasing is we will be increasing my working capital with the sale value or sale proceeds of non-current assets. And sale proceeds would automatically, adjust the gain or loss. If net book value is 200 and you have sold the asset for 220, you will be taking 220 as a positive source of working capital under this head of sale of non-current assets. Since this 20 as a gain was also included in the P&L, you will be subtracting that gain because you are taking it here. Otherwise, it will be double counting of your same gain. I hope that this is clear. So, what adjustments are you required to do is that you need to add back amortization and depreciation, and you also need to adjust any gain or loss on sale of fixed assets because that is taken separately. Similarly, you know that whenever you issue share capital, whenever you take long-term loans, then your cash would go up. Since your cash is going up, your working capital will go up. Therefore, it is taken as a source of working capital. Similarly, when you take a short-term loan, then also your working capital will go up. Therefore, it is taken as a taken as a source of working capital. So these four, funds from operations, sale of non-current assets, issue of long-term finance and raising short-term finance is taken as a source of working capital. Similarly, when we talk about uses of working capital, it says purchase of long-term investments. Whenever you purchase something, it involves cash outflow, working capital goes down. Therefore, whenever you are using your working capital, it will be deducted. Your working capital goes down. So one example of it is first component of uses of working capital is purchase of long-term investments. The second one is payment of long-term loans. Whenever you are paying off your obligations, your cash would go down again. Similarly, whenever you pay off your dividends, cash would go down. Right? So this ways, guys, we have understood that what are the sources and what are the uses of working capital. Because of sources, you get the amount of working capital and your working capital goes up. And because of your uses of working capital, your working capital goes down. So in any accounting year, what is the net increase in working capital? It is nothing but sources minus application of or uses of working capital. With this, you will be getting that what is the net effect on the working capital in any accounting year. Right? So with this, our funds flow statement format is very ready. Sources of working capital takes into account 4 things. Uses of working capital takes into account 3 things. If you deduct uses of working capital from the sources of working capital, you will be getting the net changes in the working capital. Let's understand that we have understood anything or not through the help of certain questions. Which among the following will change the net working capital of the firm? Guys, we know that there's a shortcut. What is the shortcut? The shortcut is this. The shortcut says that the net working capital will increase or decrease. That means net working capital will change when a, when a transaction involves one current aspect and one non-current aspect. For example, machinery purchased using cash. Net working capital will remain unaffected when the transaction involves both current aspects or both non-current aspects. So with this, it becomes all the more easy only if the transaction is involving one current and one non-current aspect. Only then your working capital will change. Now let's go back to the question. The question asks us, first thing, creditors being paid 50,000. If the creditors are being paid, your current liabilities would go down and your current assets would go down. Since it involves both current assets, working capital will not change. Second, land purchased by issuing shares. One hand, land is going up, another hand, share capital goes up. Both are non-current, therefore working capital will not change. Debentures of 2 lakhs are being converted into equity. One hand, debentures are going down and another, equity is going up. Since both are non-current long-term items, working capital will again not change. Purchased machinery of 70,000. Your cash going down and your machinery, which is a non-current asset, going up. Here one is current, another is non-current, therefore working capital will change. Since your current asset is going down, working capital will go down. So this is the answer for this particular question. Let's analyze E as well. Collected money from receivables, both cash and receivables relates to current, therefore working capital will not change. I hope that this is clear. If not, please ask me the doubt. Now, the next example is asking that will not change the net working capital of the firm. Depreciation of 1,000 has been charged on the machinery. See, here depreciation is a non-cash expense. It is not relating to any change in the components of working capital. Therefore, working capital is not changing over here. So, A is the correct answer. And let's understand that why B, C, D, and E are not the correct answers. If we talk about B, electricity expense got due but not paid. Here, current liabilities will increase, working capital will change. Insurance expense paid, current assets going down, therefore working capital will change. Goods sold on credit, again your current assets going up, therefore working capital would change. Issued equity shares, you will be receiving cash and your share capital will go up. Since current assets is going up, your working capital will change. So I hope that this is clear that why A is the correct answer. The last question of today's class would be, there if sources of funds are 2,50,000 and total application of funds are 2 lakh, then what will be the change in the net working capital? Guys, we know that because of sources, working capital goes up and because of application, working capital would go down. Right? You are applying the funds or using the funds. So 2,50,000 is the increase and 2 lakhs is the decrease. So the net increase in the working capital would be 50,000. So B is the correct answer. Guys, if you have understood funds flow statement and if you are interested in, getting these kind of regular updates from our experts faculty, you should definitely subscribe to SEBI Grade A online course, in which you will be getting video lessons, you'll be getting study notes, which are, comprehensive study notes. You'll also be getting practice tests. There will be live sessions in which you can interact with your teacher on a real-time basis. Along with that, you'll also be getting interview guidance. It's the right time. You're also getting a flat discount of 40%. So you can use this code. You can also, for any counseling kind of thing, you can also call us at this particular number. You can also see the website of ours and do not delay in enrolling the course. For regular updates from this channel, please click on the bell icon and subscribe to the channel.